Welcome to the Smart Property Investment Show, the podcast by investors for investors.
Well, good day everyone, it's Liam Garman here, editor of Smart Property Investment, back today with another episode of the Smart Property Investment Show. And I'm joined by someone who's, you've blown up on our socials, you've blown up on our YouTube, our Spotify. Steve Ash, buyer's agent and founder of Property Strats. Mate, welcome back to the podcast.
No, thanks for having me. Thanks for the warm welcome. It's certainly not the good looks, so there must be something I'm saying that's resonating or something. So that's good.
Yeah, well, I mean, to be clear, your last podcast was with Phil.
Yeah,
our other co-host here. So maybe we've got a baseline that we can improve on, or maybe I'm going to drop the ball. We don't know.
No, let's see. Maybe, I'm sure we can improve on Phil. Maybe it's Phil who's garnering all those sort of likes. You know, there's always a good banter there. So I'm looking forward to this. And yeah, we just obviously met a few minutes ago, but always happy to talk property and get into it. So yeah.
Oh, we've been talking about some absolutely awesome stuff, which is what we're going to be unpacking today. We're going to start off with discussing the Melbourne market all the way through to some concerns that people have over the Melbourne market in terms of cash flow, how you can plug that, and even moving into something that I think a lot of people get a little bit nervous about, which is units. But Steve, talk to us about the state of the Melbourne market at the moment. What are we looking at?
Yeah, no. It's good comment. Obviously, we spent a bit of time, unpacking this a little bit with Phil at the moment. So when we last talked, we're definitely starting to see some movement. Obviously, a lot more interest coming in. But now with just I think we're 2-3 months on from there, some markets are really, really far along now. Sort of a lot of competition out there. First home buyers out. Obviously, we've had the 5% no LMI coming in October, so that's actually been more fuel to the fire. And a number of suburbs have done incredibly well. Like we do. So it feels. And I've said this quite a few times. Like this time last year, it was really, the market was cold, not many people buying there. We were looking heavily into that sort of market. We've always been, as an investor, I've always been a bit early to sort of markets, but that's where I want to do. But now I think what I was saying to investors back then, I think it might be a couple of years, before we start to see sort of some upward momentum. But it's actually kind of taken off a lot more than I think, and we're certainly seeing a lot more owner-occupier or first-home buyers at opens now, and it's just getting hotter and hotter. So it's exciting for the people who've got in. It's frustrating for me. I can't buy at the moment, but it's great.
Are you capped off?
I am capped off. Yeah. But it's exciting for people seeing in and making good money now. But I suppose. We're not talking speculative investing. We're talking Melbourne, like, the sort of second biggest city in Australia, sort of world-renowned, world's most livable city for a while. So it's really good opportunities. Obviously, there's some downsides to it, but from a capital growth point of view and a portfolio construction point of view, which is what we're looking at, it makes a lot of sense, especially if it's your first property, to go into Melbourne.
Now, obviously, you highlighted that the Melbourne market is not one big monolith. Some areas are overperforming relative to other areas in Melbourne. Some areas are underperforming. Now, a lot of people on this show don't necessarily like to talk about the postcodes, talk about the locations which are overperforming. But if possible, could you tell us what those postcodes are, what those LGAs are, what those suburbs are that are performing very well in Melbourne, and what makes them perform well? What are the underlying characteristics? What's the underlying principles of why those markets are performing better than other markets in Melbourne?
Yeah, no, it's a good question. If you look at kind of PropTrack data, you can see that the Melbourne numbers are pretty flat for the year, which is quite staggering. But we always know, as property investors, there's markets within markets, and there's always an area that tends to be doing quite well. So the obvious one, and I talked about this with Phil, is Frankston. It's around this sort of time. You're having a bit of interest from first-time buyers, but as soon as January, February kicked in, I think it was just the people priced out of Bayside. We were seeing 15 to 20 groups in December. Then all of a sudden, when the rate cut came down in Feb, seeing 50 groups, and those prices that we were looking at, say Frankston North, a little bit lower socioeconomic. It was, I think the median was around about that sort of 550,000 price point, and if we fast forward now at 650 to 700, we're seeing those sort of deals for Frankston was around that sort of early 600s. and now that's kind of mid 700s in many of the pockets there around the Frankston High School zone, Kerringal. So I think that's largely been driven by first home buyers looking for value. The other interesting thing in those markets, like houses have done well. If you're talking to the agents and the units and townhouses, which are really, really affordable, like just, around this time last year, about 200, 250, you could pick these up. I know it's incredible, isn't it, for a 2-bed, 1-bathroom? So they're very popular with people looking to get on the ladder. So that's one market. The LGF Melton's done very well as well, sort of over the last few months. So Melton was a bit divisive. Everyone sees lots of land around Melton and thinks there's going to be lots of supply concerns. But what we're really seeing is that developers haven't bought that land, and it'll be years and years before that does come into effect. And if it does, then the house and land will be a lot more there. So the established areas like Kurrajong, which is a nicer suburb in Melton, Harkness, Melton West, those areas where you're getting houses on pretty big plots, 700 square meters, anywhere from 550 to 700 square meters, being very popular with families and pretty good long-term growth rates over 10 years. And so I'd say those areas have been up 10% over the last 6 months. So
wow,
so
10% in 6 months.
Yeah. Well, a lot of the deals that we've been seeing, sometimes it's not representative right in the data, but just on the ground, we know that data lags.
Yep.
That's like deals that we were picking up earlier in the year have moved quite significantly, and almost to a point where it doesn't really make sense as much now. I think it does from a long-term point of view, but what we're seeing is a lot of affordability in these areas, and that's really, I think, what's moving. Now, if we look at Melton as well, it's got one of the highest interstate migration rates as well. I think it's around that 6.5% mark. Massive. And so I think Melton's around 140,000 population. So yeah, that's another thing that's sort of driving there. So there's a couple, there's more, but pulse check on the ground, that's what we're seeing.
Now, while I've got you in the studio today, you've got a background spanning finance, and it's fantastic to be able to pick your brains on this. Goldman Sachs, State Street, Australian Super, ART. You know your stuff when it comes to finance. Now, on this podcast, I think a lot of our listeners would know that I've been talking about the first home guarantee for quite a while now. They've heard me rant about it to no end.
Yeah.
You highlighted that in a lot of these areas you are seeing an influx of first home buyers. What do you make of that policy? What do you make of some of the other government policies coming in? What, again, are those areas most likely to benefit from those policies that the government's introducing?
It's a good question, and I think with interest rates coming down and obviously these policies, it's going to be fuel to the fire in the market. And I know that they're trying to help people get onto the ladder, and I think that's a good thing. I think it's the Australian dream, isn't it? To purchase a house. It's interesting when you look at the kind of like the buffer per city or state as well, like Melbourne 900. I think Brizzy's 1 million. Yeah, Sydney 1.5. So clearly they've just upped those kind of rates. I think it's it's going to be very interesting how it plays out. I think like if they want to control the house prices, and it's been talked about a lot by probably people with a bit more know than myself, but really it's that supply problem. If you fix that, then probably these sort of grants don't need to happen. But it's going to be complete fuel to the fire in some of these areas. If we take an area in Melbourne, like Point Cook, for example, and the market's move in cycles, and so obviously Brisbane had that sort of cycle from didn't do anything from 2009 to 2019, and it's moved quite a lot. But now what we're seeing is Brizzy's quite unaffordable. I think the market's going to perform quite well because of the Olympics, and there's not too much supply housing, and 58,000 or so people coming for the Olympic Stadium. But I think more as part of the cycle, more people will kind of, it's just common sense really, will look towards Melbourne like they did to Brisbane back then and say, okay, if I'm in Sydney and Melbourne, I'm looking at Brisbane, I can buy Mitchelton or somewhere like that and get a house on 600 square meters for 700,000 or so, and the rent's maybe 400, 450, 500. So I'm going to move there. If we fast forward now, it's largely unaffordable, and Mitchelton's around about 1.2 million. The rent's a lot more, and so all of a sudden Melbourne looks pretty cheap. And so if I'm a first home buyer, and I'm kind of agnostic to where I live, obviously Aussies pretty sticky from where we grow up, and we like to stay there. But if you do have that view and you do want to get ahead, I think it's just this will play out, and you can look down and you can look at some very, very good areas in Melbourne, like Point Cook's a very good example of this massive suburb, 16 estates, but you can get a 4-bedroom 422 house around about the 750 mark.
Yep.
And so I think what you'll see is when this policy comes in, prices will move right up. So whether that's what the government's really trying to sort of whether they're trying to help people, I think it will, but then it will have that kind of, added whatever the word is, negative of sort of just kind of making housing even more unaffordable unless they fix those supply problems. And we see year on year, the supply numbers and houses being built are well below what they forecast. And so I still think that's something they need to address if they really want that affordable housing to sort out. So did that answer the question a bit?
Oh, that absolutely did. I think, and this is a topic that we're going to touch on a few times throughout this podcast, and you and I were discussing it before we started recording, which is, the arbitrage aspect, which is you're always looking for the next marginal gain, right? And your point's very reasonable, which is there's a reason why if you're an informed investor in Sydney, you're probably not buying in Sydney.
Yeah.
There's a reason why if you're an informed investor in Sydney, you did look to Brisbane, then you look to Perth, and that you might now be turning to Melbourne for the next best deals in terms of the underlying value of the asset versus just how much that asset is going for. And you're going to have a lot of investors now in Brisbane that are going to be doing the same thing. A lot of people who might live in Brisbane that have had a fantastic run of investing in Brisbane that might now turn south to Melbourne as well. But with this, I did mention we're going to talk about arbitrage a few times because one thing that we want to discuss is how to incorporate lower yielding Melbourne assets into one's portfolio because see, we are constrained by how well our assets perform, and not everyone can necessarily take the hit on the back pocket of a hugely negatively geared asset, hoping that one day the capital base will grow. So how do we tie it in?
Yeah. I just want to cover something on the arbitrage just quickly, and then we'll go into sort of like how you can incorporate it in, and that's kind of what, again, going back to the Brisbane example, how those kind of land to asset ratios were extremely high back in sort of 2018, 2019. And if we look at Melbourne, the land to asset ratios in many areas are sort of pushing above 80%, sometimes 90%. And even that might be in, say, a Frankston or Broadmeadows, for example. But even if we look at the area I was just talking about, Point Cook, sort of newish estates, and the land alone, so obviously there's smaller plots in Point Cook, but 350 to 400 square meters, and that land alone sells for sort of could be anywhere between 600 to 750. And so if you're buying a house around about that 750 mark, depending on the land size, to the cost to construct that's going to be about that 1.1, 1.2 to be very, very conservative. Yeah. And so there's only one way that the prices to construct is going. So there's no more scarcity of land actually in most of that area. So that provides that opportunity. So it's that arbitrage at play, and we'll go into another example in another asset class in a second. But if we look at so we've kind of deemed, okay, we've detailed out now that Melbourne's a good place to sort of start. And for a property portfolio, what we're looking at is to get that capital growth so we can get equity extraction so we can keep going. And I think some of the other markets obviously will do well. I think Perth will be double digits maybe in the next couple of years still, Brisbane. But we're coming towards the end of it, and I like to get in early into the party, as I've talked about, and gone from there. So what we've done, if we look at the kind of round the grounds, and Phil and I talked about it, you used to be able to get the cash flow and the capital growth. And you can still do that in some assets, but really houses, when they're so undervalued, when the townhouses and the houses are fairly similar prices in many areas in Melbourne. So Melbourne just kind of sticks out like a sore thumb. You were talking about the socials, and that's what everyone wants to hear about Melbourne at the moment. But how do you incorporate Melbourne into the portfolio? So we know that if we buy 2 Melbourne properties, for example, you're going to have a 4% yield, 4.3% maybe best, unless you get a dual income or whatever, or a bit of a unicorn deal, I should say. And so if you do 100% lend, you're going to be down after tax about 15,000 a year, before tax about 22. So if we hold 2 of those 44, that starts to get quite harder, especially if
that taps out a lot of our listeners. That taps out most Aussies, really.
It really does, and it hurts having been through it myself. So I've always, while I have been a cash flow type investor, I've also wanted to get a slice of the pie, in slightly better suburbs. So instead of maybe getting that 6% yield, I might take a 4.5% yield. I did that in Perth. That enabled me to get into Naranda and Queen's Rock and some of these other sort of more owner-occupier friendly. But I mix it up with cash flow. And so here, and then you've also got land tax as well. I don't think land tax is a big deal for property one. And the reason being is that fees are a lot lower in Melbourne compared to, say, to Queensland, for example. Property management fees are lower. Insurances are lower. And so they kind of net off. But as soon as you start getting into 2 to 3 properties, then that land tax goes up exponentially. But again, when you come back to it, to grow that portfolio and get that portfolio mix going, you really need that capital growth to be able to extract that equity. So that first purchase, the rules are just a little bit different now. So we couldn't really go and get that 5-6% job in Moreton Bay or Logan or somewhere. And so it just requires that bit of planning. Aim for that 4% yield, but the first one in Melbourne, you want to capture that market. You don't have to build the same portfolio as many of the people who come on the pod does. It just might be 4 to 5 really quality assets, but I think you do want to capture. I think Melbourne market will be probably the best performing capital over the next 5 to 7 years with the long-term time.
5 to 7. So it is quite a long-term play here.
Well, I always think long-term. I mean, investing, we're getting shorter and shorter. We're talking about just before we came in about socials. Everyone's up 100K. I bought in, I don't know, maybe not Broken Hill, but you know what I mean?
Insert LGA here, insert hotspot here, the hotspot chasing aspect of it.
Exactly. The hotspot, and that's that sugar hit. And you get that, and it's amazing. I'm a genius, blah, blah, blah.
Yeah.
But really, we're looking at long term, 5 to 7 years. And if you buy well, buy in the market value, or find a bit of a twist where you can convert, say, a 3-bed 1-bath to a 4-bed 2-bath or something, that's something you can control. So you can always have that control of whatever, no matter what the market does. But if you do that and get that up front, and then you can hold an asset for 5 to 7 years, you've got that organic growth to come.
Yes, of course.
And so from my research and what I look at, I think over the next 5 to 7 years, Melbourne's incredibly undervalued in some of the suburbs I've talked about. They're already moving, but you're going to get that good uplift. And so that first asset, capital growth, Melbourne, but we're talking maybe 21,000 down before tax. You can obviously do a PAYG withholding, get that smooth throughout the year or something like that. But I'd be looking maybe a second asset somewhere else, depending. Obviously, everyone's circumstance is different. Obviously, if you've got a high payment job, you can just keep going. If you're kind of on a lower payment job and you've really got to look, which most of us are, then you start to look to kind of pair those assets and look for something that's going to help you out. So you can always think about number 3 or number 4. And the goal is always to get that portfolio value up to as much as you can. Hold, let time do its thing. Hold for 10 to 15 years, and then you're going to have all the options open to you. And so obviously personal circumstances is different, but if we look to incorporate one Melbourne asset into the portfolio, depending on where you're at, a second one needs to have that cash flow element to it. And so instead of being down 40,000 a year and everyone starts tuning out the podcast and thinking, oh, that's just ridiculous, then you're kind of seeing what you can do. And it might be an asset that's kind of returning 6.57% yield, but will have capital growth as well. And it's all just about the long-term game and how you can do that.
Now, we'll get on to what those assets look like in just a tick, but you did mention land tax in Victoria, and I know it's something that has scared off a lot of people. And again, oh my gosh, I must sound like a broken record talking about the arbitrage. But this is where it factors in, right? Because whereas 2 or 3 years ago, land tax was so frightening to so many investors about looking into the Victorian market because there are all these additional taxes. Well, now the value of the equity uplift that you're getting, the capital growth on your asset there is now commensurate plus some to the additional tax that you're paying by investing in Victoria. Can you give us some insights into what the calculation of Victoria's land tax is?
It's a good question. I can't say off the top of my head. I mean, roughly, I think if you've got that land around that 500,000 mark, I think it's roughly about 1,200. But as soon as you hold a couple of assets. The land value, I think I can't remember the actual term, but as soon as you go above $1 million in land holdings, it goes up exponentially.
Yep.
And I believe if you hold, and this is one for the accountant, so I don't want to tread on anyone's toes here, but if you do buy properties in a trust, I believe the land tax is a lot more.
Yep.
And so that's something. So again, talking what entity to buy the properties in is so important, and really speaking to your accountant, understanding the ramifications of buying in both names or one name, or how you can spread out the risk.
Which I mean, that's the vibe that I get. I whenever I speak to investors about investing in the Victorian market, it seems that the calculation of the land tax is incredibly challenging. Like it is. There are multiple different variables that go into the calculation of the land tax, which mean, especially when you're dealing in the low millions, right? You can hit that tax threshold very easily.
Oh yeah, no, it really does start to when you've got over $1 million in land holdings. And again, I don't have the calculations in front of me. I'm pretty sure it's around that 5K, 6K mark.
Yep.
And it just goes up exponentially on a sliding scale. So it's definitely a consideration, and just factoring it into the costs. And so it might just be, as I said, like one or two properties, and then you tap. And the other thing, I mean, the land tax, I think for one property's not a massive deal. We could, as we talked about, if we buy in regional sort of far north Queensland, for example, insurance costs might be, I don't know, $3,000 for a house or whatever if it's in a cyclone sort of affected area, and whereas it's $1,300, $1,500, so it kind of nets off almost just on insurance straight away, and then rates and blah blah blah. But the other thing as well to be wary of, and I've talked about this a few times, and I actually think this is maybe the bigger problem than land tax in Melbourne, is the actual tenancy standards.
Yes,
and that is.
I've heard some horror stories.
Yeah, it is. I've seen some horror stories.
Yeah, can you give us some insight?
Well, yeah, and this is. I mean, I obviously talked about Point Cook, and if you most of us are busy individuals, professionals, working away, and so sometimes getting a set and forget really undervalued asset that is going to be compliant is better than buying a house that's maybe, I don't know, 60 years old, for example. Like let's just say, I mean, we were talking about high land to asset ratios a second ago, very close to the city. Where you're getting the house for say 600,000, lands alone 500, but what you might have is a property that's not compliant. Get from a gas and electric point of view, might not have curtains or whatever it might be, locks on the windows, all of these things that you need to do to sort of make it compliant. So you've got to pay the compliance each year. It's about $500 to do electric and gas. There might be, the switchboard might be old and need to be completely replaced. There might be issues with gas lanes, all like piping, whatever it might be. But all of this money is not kind of sweat equity. You're not paying $1 and getting $1 back. And that's money just gone down the drain. So I think for people really looking in those areas, like they've just got to go in with their eyes open and know that potentially there's going to be a few thousand to fix this up and make it compliant. And so that's one of the, I'd say that's a bigger issue depending on what asset selection that you buy in Melbourne. And it's certainly for myself, we're looking at it from an investor point of view, but actually obviously working with clients and seeing what their risk profile is makes a lot more sense sometimes to get something that is going to be compliant, not a headache down the track and have a few maintenance costs. So I think that's potentially a bigger problem than a land tax.
Yep. Yeah, absolutely. Now, the value of units is a topic that I think a lot of people look at with a lot of interest, but this could potentially be a solution to that cash flow problem that we gave in the example before of an asset that has to be held for the long term, could potentially have some huge capital growth, but you're not getting as much money from it as you could be otherwise. Can you talk to us through that?
Yeah, definitely. And this is where tomatoes get thrown at me, when I start talking about units. And it's quite a funny one because I think we're all conditioned, and obviously with the advent of social media, podcasts or whatever, and houses have been on absolute tear. There's no doubt about that. And generally the outperformance on a house will always be much more than a unit. But the units have become so undervalued now. And And so you will get, and if we just look over the last year, for example, just even the last couple of years, say in a couple of affordable markets that were in their cycle, where houses done incredibly well. Brisbane's a classic case. And so in the last year, I think units have outperformed houses, and we're only talking about 1 year. So I mean, obviously, I'm not cherry picking data, but just giving an example. But in about 70% of the suburbs, units have outperformed. If we look at, say, someone like an Annerley, for example, like 250,000 to buy a unit in 2022, extremely affordable, and now they're sort of 600, 650. Probably understating it, and then the yield obviously on some of these purchases, like 220, you're looking at that 6.5% yield or so. Perth has followed suit. Some of those areas we were looking at about a year ago, Victoria Park and those sort of areas, you could pick up in the threes, and they're now kind of, I think, in the fives. Sort of sometimes 7 to 8% yields. But really, kind of, it's not just investors snapping those up. Obviously, good for the portfolio, which we'll talk about in a second. But it's again, people chasing value, just wanting to get on the ladder and get something that's affordable. So it makes sense in so many ways. And if we look at sort of like the price disparity between houses and units over time, it's generally been about units trade at about a 25% discount. And if we look at, I'm going to have to, because I haven't got the photographic memory, but if I look at some of the discounts at the moment, so Sydney units are trading at a 57% discount to houses at the moment.
Yeah, right.
So you're talking about arbitrage. Maybe you're going to have to name this arbitrage episode.
Yeah, I think it is. Yeah,
that's an arbitrage play already there. Melbourne 42%.
Yeah.
Brisbane 37%. So that's obviously a bit closed up. Adelaide 34%, Perth 38%, and so I think there's an opportunity. I'm not just saying units are better than houses, but there's sometimes where, as investors, we've got to look for opportunity and look for that sort of how it's going to unlock our portfolio, but then also looking at kind of what's going to be the best asset that sort of performs. And clearly, I'm saying there's value in Sydney. There was value in Brizzy, and Brizzy's done incredibly well over the last 2 to 3 years. But the great thing about something like this with your portfolio, if you have sort of picked up a Melbourne house, and we just talked about the numbers, after tax maybe 15 grand, equal that lower purchase price, you would. The irony is, before we came here, you were talking about some suburbs in Sydney, and I'm thinking, you've nailed it. Those are the good areas where there's good opportunity with good yields. So Auburn, for example, Lidcombe, where you might be sort of even in the fours sometimes. Like you might be able to get the deals, and the rents would be in that 550 to 600. And you might be getting that 6% to 7%, well, not 7%, but 6.5% yield. And so if you start combining those assets, what you've done is you've increased the portfolio value. So let's just say a Melbourne house at 700,000 with a 4% yield, and say unit 500,000. So your portfolio value is now 1.2, but the negative cash flow is still around that sort of after tax, maybe sort of 18,000, and then we've got tighter vacancy rates here, and so we will start to see them come up. And then if we get some decent growth across the two assets, then there's another sort of like deposit, again go back to sort of capital growth. So whereas it used to be, okay, I can get I don't know, a Logan house, a Mount Druitt house, blah, and just keep banging, and you can't really do that anymore.
Yeah.
So you just need to be a bit more creative with it, and that's kind of where I see the unit as the grease in the engine, like, and there's opportunity. And if we look at Sydney, done nothing in 10 years or so, the unit market, and that's exactly what we should be looking at. Everyone's a contrarian, but the real contrarian play that's staring right in front of our faces is the opportunity in units at the moment.
Yeah, I can. It was funny when you started talking. This is the point at which people start throwing tomatoes at me, but it is. The way that you just worded that then is very reasonable, because on every podcast we talk about, hey, this Perth, didn't move for like 10 to 14 years, and then suddenly it's. Arguably, you could say it's catching up to the mean at where it should have been, because wages have increased in those times. We're talking about government incentives have increased in those times. All these things have come through, but the average house prices kind of stayed the same. So therefore, you're catching up to that long-term CPI growth that you would expect.
Yeah.
So the contrarian play should be units in Sydney, for example, which I think it's a bit of an insight into your mind, Steve, because that's the kind of you should be treating, if you're an investor, you have to go back to the fundamentals of asset diversification, right? And this is an insight into your mind, having spent years and years and years working in finance. Because if we're looking at equities and you have an equity, a share, which is just super high volatility. Super high volatility can be good when it's going up, but volatility is also measured on the way down and everything in between. So when you have a very volatile asset, what do? You balance it out with a very stable asset that might have higher paying dividends. Yeah. Sure, you might not get that 25% year-on-year growth. It might move up 4%. You might say, well, it's underperforming the rest of the market. I should do this, I should do that. But then you're factoring in, say, that dividend growth as well. So what you're doing here is, you're acknowledging that some of these growth areas will have high swings, might not have much dividend growth. We're going with that equity example. But what you're doing is you're going for that stable asset to just create that balance, create that diversification. Also, at the end of the day, it means that you're not going to bankrupt yourself by having $40,000, $50,000 a year negative gearing.
Well, no, absolutely. And it's not even bankrupting yourself with that. It's actually very hard psychologically to hold that. If you know that asset, like the cash flow's going out, and we're talking like on paper the first couple of months are okay, but when you're doing it for maybe 2-3 years, it does start to become extremely hard. And if you don't see that asset grow, because we know, okay, if we look at the long-term performance rate of property over the last 30 years, it's 5.9%, but we all know that that's kind of it's not linear, and so you might have those. Like the point in case is Brisbane. I bought in Brizzy in 2014, I think it was, and we waited a long time. And it's quite hard when you have that flat time, but you need those flat moments to obviously get the exponential growth. So when it does come good, then you've obviously been holding it. So with units, it's obviously going to be easier to hold, a more decent yield. Obviously, we look at not all units are created equally. I'm not talking about the big high rises with the lifts and the gyms and the spas or whatever it might be with high body corporate, but something where the body corporate costs are maybe between that 2,500 to 3,000 a year, and then you look at all the cash flow analysis, and it's going to be fairly easy to hold. We're talking arbitrage a second ago. The units, if you are picking up around that 450 to 500 mark to construct a unit now is, I think it's minimum 550, and you take into account holding costs and then landscaping, it's more like 750. And so there's that kind of play there as well. But if you've got you're in a block of units on, say, I don't know, 700 square meters, and there's 6 units on there, or maybe 9. There's a land component anywhere to that. A number of these areas, if you're within 300 meters to a station, have been rezoned, I think, to R4. And so for a developer can make a lot more of that land. But for now, you can hold that. There'll be exit strategies and what you can do down the track. So there's a number of things where we can play this, and just going back to the psychology and the contrarian type asset, like we look back, it's always funny. Like you're talking about the stock market, and having gone through the financial crisis and seeing, I was at State Street at the time, seeing the stock price of State Street, I'm going to get this wrong, but drop in a day from 52 to about 9 and bounce to 14 or something ridiculous. And then everyone would say in 2025, well, yeah, everyone should have bought stocks in 2008, but everyone thought the world was
ending.
Absolutely ending. Yeah. Like we didn't like people buzzing in with their passes, wondering if it was going to work in Aurora Place, just around the corner. And it was a scary time. So it's very hard to do that. And now if we kind of extrapolate that to the property market, Perth, like people have been waiting for Perth to grow, and to actually go and start buying in 2020 and 2021, extremely hard. And I remember like saying something. I was still in corporate saying, I'm buying in Perth at the moment. Everyone just thought I had rocks in my head. Well, Brisbane, blah, it's all about Brisbane. Yeah,
but everyone's already jumped on the Brisbane.
everyone had all, and that's about rewiring your brain. And so now we look at Perth, and still people buying, and might do okay. That's for others to decide. But still, you've got this. We've seen that assets can grow. We just talked about it in Brizzy. We talked about it in Perth. And in Sydney, even some more premium suburbs, there's value there. But no one wants to do that because units never grow. That's what we hear. Yeah. And so that's the psychology coming into it again that makes it very hard to proceed when just exactly what happened in Perth before, just what happened in the GFC. With the GFC, you had to almost wait 5 years before you started seeing profit because you had the debt crisis in 2010, which knocked stocks right down again.
Yeah.
And so again, it comes down to like holding those. Have you had a position? I mean, I had positions in Citigroup and Bank of America, Goldman, and Microsoft, and they just didn't do anything. And then finally, we had liftoff. And I think that's a similar thing to what we're seeing with units. It's not going to be the same as the stock market, but they'll perform well, and they're not going to go down. That's one of the most important points.
Oh, for sure. What it reminds me of is, when you were talking about 2020, 2021, and you first started moving into Perth, but everyone's like, Brisbane. What's that? The taxi driver heuristic adage, where it's like, when your taxi driver starts telling you to invest in something, then that's the time to sell, because you've hit that point of saturation where if you have that much of a herding behavior, if that many buyers are herding there en masse, then you might have hit the peak, you might have hit the summit. So it takes me to wondering regarding the units. Perth was brilliant because it had the underlying economic, the underlying financial reasons of doing it. You had 10 to 14 years of, like we said before, wage growth, et cetera, without the commensurate growth in property values, which meant that as a city, it could stay buoyant after, 15, 20% year-on-year growth for the last 3 years in property.
Yeah.
When looking at or examining a unit to buy, or people out here that are like, oh, this is going to be really good to diversify because I can't go into the next freehold in Melbourne, or I can't go into the next freehold in Adelaide, or whatever it might be. This might be a good way of balancing our portfolio. What are some of the underlying economics, some of the underlying financials, some of the underlying data about what makes a well-performing unit versus what makes a poorly performing unit?
That's a really great question because, and we touched on it a little bit, not all units are created equal. And you were coming up with some sort of new developments. I think it was you're talking about Auburn.
I mean,
really horribly designed.
So just before we started recording, you and I were talking about the difference between, say, the really depressing high rise that looks like after 5 years has got concrete cancer already versus your medium to low rise that after 60 years is still going pretty strong, right?
Feel like a tank.
And then that's where your point about the body corporate comes in, because we know a lot of these builders might leave some money in the kitty, which then over time gets eroded, and then suddenly everyone's strata goes up through the roof overnight once that's gone. Whereas you don't necessarily have that for the older style, low to medium rise density. So it's exactly that. The way that I'm interpreting that is that a lot of the underlying financials, it's actually or the underlying data about what makes a well-performing versus a non-well-performing unit, it's actually quite similar to houses. Supply, quality, the same.
Well, it is. And obviously you look at those areas and if there's a lot of high rises around, say, let's just take Zetland, for example, like that's obviously an area to avoid. But if you can get sort of houses or apartments in those boutique blocks, like on 700 square meters, I talked about earlier, 1,000 square meters, you're close to a station. There's not too many high rises around that sort of particular area. There's a land component into what you're buying. And it's maybe in one of these areas. I mean, there's been some very generous sort of rezoning that's happened from the New South Wales government, where you know that you're getting decent yields, decent cash flows, and then for that particular property, you're getting it below replacement cost. That's another thing. And then you have to do a bit more due diligence on the units as opposed to a house. So there's quite a few things you need to look at. Like you just talked about a few of them there about the big blocks there. But obviously we don't want to have something that's got lifts and all of this sort of jazz where you're going to have higher body corporate costs. So we want to look at that sinking fund. So we want to see a healthy amount in the sinking fund. We want to have a look at the AGM minutes, and we want to sort of see what works are being carried out, or if there's any big works that are coming in, because that could potentially create a special levy and could blow things out. With that, we want to look at how much the body corporate, the strata costs are going to be, and just to have a look at kind of how many sort of owner occupiers in the actual building, and just looking at that sort of, I think as well, gap between what the house prices are and what the unit prices are. How much the gap between the unit prices in the boutique blocks are to maybe the newer type blocks, and seeing if there's a bit of a discount there. And so there's many ways to look at this. Looking at sort of layouts like floor plans, seeing if, for example, there might be a laundry that's quite big in there and it's a 2-bed 1-bath. You might be able to convert that laundry to a second bathroom or something like that, similar to how we create sweat equity via a house, like views. I mean, there's been some pretty good deals in 5 Dock Domain for over the last couple of years where there might actually be kind of water views or wherever it might be. So, which are obviously going to be desirable for owner occupiers, but also to developers if they can do something with that, depending on location. So there's a number of things that go into it, and it's not just this new development. Like take Melbourne for example, in South Bank, big high rise. Looks really sexy from the outside. I've got views everywhere. It's going to be a lousy investment. There's a lot more that goes into it. Not all units are created equally, but if we can get that right sort of one, we are at that bottom of the cycle in Sydney. Other cities have started moving. I think Melbourne and Sydney, there's still opportunity. And talking about that disparity in sort of house prices and unit prices, those would be the 2 areas I'd zoom in on. Yep. And then it's the kind of like the suburbs within. We've named a couple in Sydney, even in Melbourne, like quite close to the city. In the west, Albion, for example, even Frankston, for example, incredibly high 2s, sometimes early 3s. They're not going to stay that way for very long.
Yeah. Looking at the property market more broadly, Steve, what are some of the opportunities going forward? We've said a few times that we're not hotspot chasing, but where do you see the state of the property market going over the next 12 months?
No, it's a good question. Obviously, we talked about the grants coming in October, so that's going to be lighter fuel over, like in the kind of more affordable areas across the whole market. So I think if we do a bit around about the grounds, or around the grounds, I should say, can't get my words out, with interest rates coming in. Or coming down, I should say, and it's looking like still that downward trend is going to continue. I think Sydney, Melbourne are generally big beneficiaries because prices are obviously a little bit more with kind of like people got more affordability, and then with decent grants here. So those markets, I think, are going to do really well and be the strong performers in the next 5 to 7 years. Maybe that's a bit of a boring sort of take, but that's how I'd see it, especially sort of units in Sydney, but houses in Melbourne clearly going to do well. Brizzy with the Olympics, I mean, Brizzy's a very resilient performer. And if we take just our investing hat out of it at the moment, and just from a lifestyle, I mean, the migration to Southeast Queens is still crazy. I think it's still number 1. I think nationwide, and we're certainly seeing the Gold Coast and those kind of I say regional markets, but markets that are very very close to Brisbane. They're still doing really well. Very desirable places to live. I think Olympics will have a boon. We talked about the amount of people coming in to do the stadium and the works there. Redlands Bay, I think in Brisbane's a very undervalued area still. Bray Park, Strathpine, Callinga. They'll all do very well, I think. And what we're seeing in Brizzy is that if a decent property comes to market, it's a very tight market. People aren't really selling. So those markets, those good assets are being sold extremely quickly. So Brisbane will just be resilient, I think, and it will just keep creeping up, and especially anything up to $1 million with the grant, that'll do well. I think Perth's an interesting one. Perth, I think, has done, as we talked about, incredibly well, but I think that there's still quite a few legs there. Kind of still vacancies very tight, especially in those northern regions, and it's still a lot of interstate migration out to WA is still continuing. So I see that market still doing well for the next couple of years, and Adelaide too is very resilient. I think there's been there's still a flight to some sort of regional areas. I think that'll become more. I think that'll drop off a little bit, and the reason being, it's going to be interesting with the advent of AI, and it's, again, a bit above my remit, but how the job market goes, and I think there'll be a bit more. COVID's behind us now, fingers crossed, hopefully nothing else comes up, but we're seeing more of a flight back to major cities, and so I think regional had a good time, but I think we'll see more people sort of coming back, and so I think overall, and I don't want to sound like a ball or a spruiker, but you can just see everything's kind of the mix, and the outlook for property is very, very strong still over the next 1 to 2 years, I think, in all of those areas. And And it's frustrating being a bystander, watching it in real time and just seeing the numbers going up. But it's great for investors who are getting out there and taking action.
Oh, for sure. I couldn't agree more. And I don't think you sound like a spruiker, because the economic data seems like it's going in a certain direction. Just off the back of interest rates alone, if you're talking about the average mortgagee saving several $100s a month, that is quite substantial.
Yeah.
Plus the plus the grants that are coming through, being able to buy up to $1.5 million in Sydney with a 5% deposit is quite
massive.
Revolutionary. Yeah, it's huge. I mean, I remember now it doesn't necessarily mean that the first home buyers grant or the stamp duty exemption changes, because that's obviously at a state government level. But I remember when I bought my PPOR in Sydney with my wife a few years ago, we didn't even bother with anything. I think it was the first home buyers grant, all the stamp duty exemptions and et cetera were all up to 600,000 for a new build. It's like, well, what are you going to get in Sydney for that? Well, unless you do go out.
Go out into the sticks.
Yeah, and that's not what not our vibe. So we had quite literally nothing, and I think that there are several 100,000 people out there that might be in that boat, that might be saying, oh, hey, maybe I will take the 5% deposit and then I'll use the rest of my deposit and go and buy an additional investment property somewhere else. There's going to be that strategizing. But you're right. I think the economic indicators are there for a bumper few years in the world of property. But, Steve, I think that is all we have time for in the podcast. Thank you so much for joining me.
I've enjoyed every minute of it, Liam. Nice, good discussion, and look forward to having a chat again soon.
Absolutely. That was Steve Ash, buyer's agent and founder of Property Strats, and that is all we have time for today on the Smart Property Investment Show. But until next time, bye-bye.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs, and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.